How are insurance premium refunds calculated? Imagine paying for a service you no longer need. When you cancel your insurance policy early, you might wonder how much money you'll get back. Understanding how refunds are calculated can help you make smarter choices. When you cancel a policy before its set end date, the insurer usually refunds the part of the premium for coverage you haven't used. The amount depends on the method they use to figure it out. The most common way is called the pro-rata method. This method looks at how long the policy was active compared to the full term. For example, if you paid for a 12-month policy but canceled after 3 months, you might get a refund for the remaining 9 months. This method is simple and fair because you only pay for the coverage you actually received. Another common method is called the short rate method. This one also considers the unused part of the policy but adds a penalty fee. The penalty covers administrative costs and makes the refund smaller. If you cancel early with this method, expect a lower refund than with the pro-rata method. The penalty could be a fixed percentage or based on a schedule depending on how long the policy was active. Some insurers use the rule of 78, also known as the sum of the digits method. It front-loads the premium, meaning more of it is considered earned in the early months. If you cancel early, the refund will be smaller because most of the premium was already earned. This method is often used for credit life insurance or loans where the coverage decreases over time. The actuarial method is more precise. It uses detailed tables to calculate the refund based on risk and time factors. This method is common for credit insurance and can give a fairer refund because it considers more details. The rule of anticipation applies mainly to single premium policies. It refunds the unused part based on expected coverage and risk over time. When you decide to cancel your policy, check your policy document. It will tell you which refund method applies and the rules for getting your money back. Sometimes refunds under a small amount, like $5, are not issued automatically. You might need to request it. Also, some plans are non-refundable or have limited refunds unless laws say otherwise. Knowing how refunds are calculated helps you plan better. If you understand the method, you can estimate your refund and decide whether canceling is the right move. Being aware of penalties like the short rate fee can prevent surprises. Always review your policy terms and ask your insurer questions before canceling. This way, you stay in control of your money and avoid unexpected costs. In the end, how much you get back depends on how long your policy was active, the refund method used, and your specific policy rules. Being informed helps you manage your insurance policies wisely and keeps your finances on track.